Lesson 1. Economic reality matters more than accounting numbers. One of the most persistent ideas in the shareholder letters is that accounting numbers are not the same thing as economic reality. Many investors instinctively rely on reported earnings, net income, or earnings per share, as if these figures fully describe a business. The letters repeatedly caution against this habit. Accounting exists to impose consistency, not to measure intrinsic value. It follows rules that often distort reality. Losses are recognized quickly, while gains in valuable assets may be ignored for years. Reinvested capital is treated the same whether it earns exceptional returns or poor ones. As a result, two businesses with similar reported earnings can have radically different economic outcomes for owners. Definition: owner-level economics. A focus on the true cash a business generates after maintaining its competitive position, and how effectively retained earnings are reinvested, reflecting the economic outcomes for the owners of the business. The deeper focus in the letters is on what can be called owner-level economics. This includes how much cash a business truly generates after maintaining its competitive position, and how effectively retained earnings are reinvested. A business that retains earnings and reinvests them at high returns may create far more value than one that distributes cash, but lacks reinvestment opportunities. The common mistake investors make is judging companies by what is visible and standardized, rather than by what is durable and compounding. The lesson is to look past the financial statements and ask a more fundamental question. How much economic value is this business actually creating over time? Lesson 2. Stocks are ownership stakes in real businesses. A second lesson that appears constantly throughout the letters is the insistence that stocks are not abstract trading instruments. They represent ownership in real operating businesses. Market prices change constantly, which creates the illusion that value is unstable. But the underlying businesses change much more slowly. They produce goods or services, incur costs, reinvest capital, and compete for customers regardless of what the stock market happens to be doing on any given day. The letters encourage thinking like a private business owner. Someone who owns a farm or a factory does not reassess the value of the business every day based on outside opinions. They focus on long-term productivity, economics, and durability. Market quotations can be useful when they offer attractive prices, but they are not instructions. The mistake most investors make is anchoring decisions to price movements instead of business performance. A falling price is interpreted as danger, and a rising price as confirmation, even when nothing meaningful has changed in the underlying business. The letters argue that this mindset turns investing into speculation. True investing requires the willingness to own a business even if there were no quoted price for an extended period. If the absence of a daily price quote would make ownership uncomfortable, then the investment thesis is likely built on price rather than on fundamentals. Lesson 3. The market exists to serve you, not to instruct you. To maintain a business owner mindset, the letters repeatedly emphasize how to think about market volatility. This is where the concept often referred to as Mr. Market becomes useful. The market offers prices every day, but those prices are driven by emotion, liquidity needs, fear, optimism, and crowd behavior. They do not represent objective assessments of value. Sometimes they are too high. Sometimes they are too low. Most of the time they are simply noise. The critical idea is that investors have agency. Market prices are offers, not commands. You are free to accept them, reject them, or ignore them entirely. Volatility is not inherently risky. Risk arises when investors act on volatility without understanding the business they own. The common error is allowing market movements to dictate emotional responses. When prices fall, investors assume something must be wrong. When prices rise, they assume they must be right. The letters argue that this reverses the proper relationship. The market should be used as a tool, not followed as a guide. Long-term outcomes are determined by business performance, not by short-term sentiment. Investors who understand this can remain rational precisely when others cannot. Lesson 4. Stay within your circle of competence. Definition. Circle of competence. The specific areas or industries an investor understands well, including a clear understanding of what they do not understand. This boundary is crucial for avoiding costly mistakes by venturing into unfamiliar territory. Another recurring principle in the letters is the importance of operating within a clearly defined circle of competence. This idea is often misunderstood as a call to specialization for its own sake, but the emphasis is actually on clarity and discipline. You do not need to understand every industry or opportunity. What matters is knowing exactly which businesses you do understand and, just as importantly, which ones you do not. The boundaries of that circle are more important than its size. Many costly mistakes occur when investors step outside their competence due to excitement, social pressure, or fear of missing out. A rising price can create the illusion of understanding where none exists. The letters consistently treat the admission of ignorance as a strength, not a weakness. Throughout the letters, there are numerous acknowledgments of opportunities that were intentionally passed over. These are not framed as regrets, but as evidence of discipline. Avoiding major errors is more important than capturing every possible gain. The lesson is that consistent success in investing depends less on brilliance and more on restraint. Knowing where not to act is as valuable as knowing when to act. Lesson 5. Inactivity is often a competitive advantage. The final lesson is perhaps the most counterintuitive. Inactivity can be a strategic advantage. Modern culture rewards visible action. Trading, reallocating, and constantly adjusting portfolios feels productive. The letters argue that in investing, this instinct is often harmful. There are no penalties for waiting. There are no required actions. Opportunities do not expire simply because time passes. The letters frequently rely on the analogy of waiting for the perfect pitch. In investing, there are no called strikes. You can wait indefinitely without consequence. The most common mistake investors make is feeling compelled to act. They sell strong businesses prematurely, buy mediocre ones to stay busy, or trade frequently to feel engaged. Each decision introduces friction in the form of taxes, fees, and errors. Compounding works best when left uninterrupted. Long-term wealth is built by allowing high-quality businesses to operate over extended periods, not by constant intervention. The letters describe patience not as passivity, but as disciplined selectivity. Doing nothing, when nothing intelligent can be done, is often the most rational choice. You have reached the end of the document.